Hi guys, thanks so much for joining us today. My name is Hannah Perkey. I'm CEO of Evelo team with Keller Williams Realty, and I'm joined by Bob Woerner, one of our top and most seasoned agents. And if you've joined us before, this is our monthly market update of what's happening in the real estate market in Central Indiana. So we will jump right in. So Bob, tell us what happened in July in our local market here.
Yeah, as you said, let's just jump right in. We've been doing this for a while, so kind of same format. Start off with a few slides. Median sales price up first. Again, this is for data ending the month of July. So last month was really the first month we had even been like flat or no incline in a couple years, but we ticked back up a little bit this month. So we slid in just under 300K for median sales price at 299.9. That's up about 1.5 points from last month, and that is still up about 3.4% from last year. So we're still seeing growth, but that growth has gone from 10 to 14% year over year down to more where we're used to in that like 2 to 6% range. Next up, we like to take a look at that days on market. So the big number here, this is our median. So that's the midpoint between the high and the low. So we were at 9. Which is increasing. Again, it's not a huge number, but that's up almost 29% month over month and year over year. You'll see two graphs here. The lower one is the median. This upper kind of darker blue is the average. The average has gone up to 32. So that's the first time we've really kind of seen the average creep above 30 in a while. So a couple interesting tidbits to follow there. Months supply of inventory, that's another one we've been tracking. Again, a balanced market is historically been considered about a 5 to 6 month supply of inventory. I've been reading some industry news lately that maybe because of the changes in buying habits and how technologies influence real estate, maybe balance might come to mean like 3 to 4 months supply of inventory in the future. But just from a historical perspective, balance was about 5 to 6 months supply. We ended July with 1.4 months, which you'll see is that, we for almost 2 years, we stayed under a month supply of inventory. So we're back up above a month, creeping up a little bit each month on that one. And then the last one kind of here real quick is that percent of list price received. So we're still right there near 100% at 99%. That is down a little bit month over month and year over year. I think the biggest thing to note here, look at these two spikes. This takes us back to the summer of 22 and the summer of 21 when we were up near 102, 103, 104%. We didn't see that. We still saw a big increase, but we didn't get to that spike this year. So I kind of found that interesting. We've stayed mainly in that 97 to 100% range this year, where we had gone up 3 and 4% on average the last couple of years.
Right. Yeah, I know that's a stat we used a lot in our listing appointments when we're trending typically above what the market is. And it was interesting the past few years because agents were like, yeah, we're getting 102%. And we're like, yeah, but that's the market average. So I think it's important for people considering listing to know that number, and it's setting expectations correctly, right? For sellers to know now that it is average to get a little bit below what the list price is.
Absolutely.
Very cool. Okay. All right. So beyond those metrics, what have you been tracking? Because we know we're in a shifting market. So what can consumers be looking at, and what are you looking at to track that we are shifting?
Yeah, so kind of maybe around this time last year, we started to notice just some subtle changes happening in the market. So we started taking a look at a few more pieces of data each month. Active inventory is one of them. Again, I hate to go all the way back to here, but if I go back to 2016, you'll see that we actually had over 10,000 active listings in July, at that time frame. So, 5,000 was the magic number for a while. You can see that, here we're from 5 to 7,000, but we still continue to be below that number. So we were at 4,200 for July. That was down about 4.5% both month over month and year over year. So that's just, again, that supply and demand. There still are more buyers in the marketplace than there are homes for sale, and this kind of backs that up. Next up is closed sales. And I know this graph looks a little crazy, but I always tell people, think of real estate, it's a little bit like a roller coaster, right? There's always a big spike or hill each year, probably between like March and August, where we kind of go up and then we go up and down throughout the remainder of the year. I think the key thing to know here is just the total number of sales is down, and that's because there are less homes available for sale. So we barely crossed 3,000 closed sales in July. To put that in some perspective, there are more than 9,000 licensed agents in our market. So that means on average, only 1 out of 3 agents sold a home in our market,
Yeah.
because we only had 3,000 sales. So I think that's an interesting stat. That was down about 10% month over month and down about 18% year over year. And then the last one we've kind of taken a look at on this front is the number of new listings. So this kind of speaks to the same thing that the last 2 slides did, but we had 3,400 new listings in July. That was down about 13% over last month and down about 22% year over year.
Okay, yeah, it's interesting. It's interesting too to see the lows on the dips are even lower, right? And then the high did not get as high. So we're just seeing that curvature a little bit shifted down overall in the total, and it's trending almost the same up and down, but just at a lower rate.
At a lower rate, absolutely.
Yep. Okay. So everyone always talks about interest rates, right? I think the normal consumer is tracking that and hearing on the news what's going on. So where are interest rates currently, and what should we know about that?
Yeah, so they're fluctuating right now, just a very small smidge under 7, keeping in mind that there's a lot of things that influence what the average interest rate is. That doesn't mean that you're going to go out today and get a 6.96% rate, but this is just kind of the weekly US weekly average mortgage rates, right? And so that is almost identical to where we were when we did this last month. I think it's up 0.15%. You can see we had this spike above near 7 last year at around the same time. It was like that August, September, October. Then we did come down into the low 6s, and then we've kind of been creeping back up. So I think there's a lot of, I don't want to say uncertainty, right? But no one really knows where we're headed. I think the general consensus is we're not going to see a large continued uptick of interest rates. We've probably settled in somewhere in this neck of the range, right? What exactly does that mean over the next 1 to 2 years? No one has that crystal ball to know for certain whether that's 5.5 or 6.5 or is it 7. But I think can be said with some certainty that we're definitely not headed back to 3 or 4% interest rates anytime in the near future. So if you've been sitting out on the sidelines thinking that there was going to be a big change there, it's probably time to kind of change that mindset and know that we're probably in these interest rates for the foreseeable future.
Yeah, I'm really glad you said that too. We had one of our 2 per year international conference for KW, and that discussion around interest rates and how the consumer feels about that was a big discussion point. And we'll probably have some data we put out on social media in the coming weeks regarding that. But a lot of the conversation had to do what's been the average over the past 50 years, right? And what can we expect to see? Because it's still a really good interest rate when we look at historical data. It just doesn't seem great compared to the past couple of years. And then the other piece is, for a homeowner, what percentage of their income are we expecting them to purchase on a home? And that's still at a pretty good percentage, right, from an affordability standpoint. So I think all of that data is good for people to know, because we do hear a lot when we're calling people who have said, hey, I'm interested in buying. A lot of people say, yeah, I'm going to wait till it gets back down. Well, that's probably not happening. Like Bob said, based on the data, we don't expect to see a swing that big, maybe ever. So yep. Okay. So any final thoughts about state of the market? That's some great data for us.
Yeah, we always try to tie in something, and it wasn't intentional, but this does kind of tie into the don't wait on the sidelines, right? At the end of the day, owning a home is still the biggest determining factor between your overall net worth versus someone who rents. And this chart just kind of shows that in real form and across a wide variety of income levels, which I found interesting. I hadn't really seen it broken down into income categories before. So you can see, this first category, 46 to 74, the average homeowner has $191,000 in net worth. The average renter has 11. That's a significant difference, right? And then the
Mhm.
opposite end of the spectrum, let's say you go up to greater than $192,000 in average household income. There, the owner has an average net worth of 1.6 versus 705. That still is a nearly $900,000 difference and nearly double, between a renter and a homeowner. So again, I guess the idea or the concept of sitting on the sideline, you're just costing yourself equity gains that you could have between today and 3 years from now. And those equity gains tend to outpace maybe what any differences in interest rates might be. And then just to tie those two together, let's say that interest rates do drop 2 points at some point in the next 2 years. There is always that opportunity to refinance into
Yes.
a lower rate, but you've had 2 years of equity growth in your home in the interim.
Yeah, and that's such a great point, right? Is we don't have to worry if it goes down. You can refi. That's always a great option. And that's something we would be communicating out with our clients about if that did happen and we know where the rate is, we'd let them know that that's transitioned. Awesome. Well, thank you for sharing all of that. I appreciate that. I think hopefully that's helpful to you guys out there watching. If you have questions, you can always reach out to us. You can comment here. You can contact us at info@eveloteam.com, or you can call us at 317-863-9011 or text, whatever your preference is. So we appreciate it. Thanks for joining us. And as always, make each moment count. Thank you. Bye-bye.